Hope everybody's doing good today. This is Mark with 318 Insurance here in Shreveport, Louisiana. I want to continue a discussion that started in the last video about long-term care insurance. And just a little bit about this. One of the things that we talk to about people, or we talk to with people, they say, gosh, that seems so expensive. And there is sticker shock when it comes to this. But I wanted to talk about the reason why long-term care insurance is so expensive. And I think it's important for us to have some perspective on this. I'm going to teach you a little bit about the insurance industry and how it works, because a lot of people don't understand how it works. It is not unlike any other business out there. It has price issues that they have to deal with because there's a cost of delivering what they're doing. The biggest reason is that the risk is high. And anytime you see a very costly insurance product, it usually has to do with the fact that there's a very costly risk associated with it. And anytime you're dealing with insurance, that's simply what you're doing is you're transferring your risk to a third party, and that third party is the insurance company, and you're doing that for a premium. Okay? You do the same thing with your homeowner's insurance. You do the same thing with flood insurance. You do the same thing with your car insurance. It's all the same type of thing. You have a risk. The risk in this case is the risk of needing long-term care services. And that's an important thing to understand, is that that risk is unique and different as compared to a life insurance risk, as is compared to a cancer policy risk or a health insurance risk. Those are all different risks that are dealt with by the insurance companies in different ways. There are a couple of things that go into every insurance policy. One is the cost of the risk. The second is the cost to administer that policy. And the third is the cost to distribute that policy. We love to do what we do, but we don't do it for free. So there's distribution costs involved with that. That has to do with paying agents and so forth like that. But the administration side of long-term care is a little bit higher than some of the others. I mean, you could think about a term life insurance policy. You buy it, you go through the underwriting process. There's a little bit of cost there. That's distribution cost. But the administration cost of that's relatively low. This one has a little bit more of that. You've got claims that have to be processed over time periodically, and reevaluations. That's one of the things that happens every year on these policies while you're on claims. They reevaluate your needs. So those are there. But the main driver in all of this is the risk cost. And that's what's important to understand. You know, the other thing that makes this a little bit worse, it exacerbates the situation, is the fact that there's a lack of competition. I mentioned in the last video, we were talking about what is long-term care. We talked a little bit about the fact that we've gone from 125 to less than 17 insurance companies that are doing this over a 20-year period of time. And because of that, you've got an issue where you don't have as much competition. Competition drives prices downward. That's part of our free market economy society. You get competition out there. If you want a Ford or you want a Chevy, one of the things that you're looking at is the price, because we're making value judgments on those things. When you limit the competition, and it hasn't been artificially limited, it's been limited by other reasons. But when you have less competition, you have less price pressure downward. And that's an important thing. The second thing that it's doing is it's limiting the innovation in those policies. Now, we've got some innovation coming back in some areas on this type of product, but we went for a long time where there wasn't much innovation at all. When you buy a long-term care policy, you got to think about it. You've got a small investment that you're making in the big scheme of things, yet the insurance company has a very large liability. For example, if you go in and get say you get a policy that's $60,000 a year in benefit for 5 years, that's a $300,000 liability potentially to that company. And you're making a premium payment of $500 or $600 a month, maybe less than that if you're younger, maybe more than that if you're older. But you've got to think about the cost and benefit analysis to that in the early years is relatively low to you, and it's very high to the insurance company. So that's one of the reasons why they have to adjust those premiums, because they just have so much liability on the backside of these things. And that's an important thing to understand. One of the things that people look at is they say, well, why doesn't that happen in, say, like term life insurance? Well, you have to think about it from the standpoint of a term life insurance policy has an end to it. If you buy a 20-year term life insurance policy, you're 35 years old. At 55, that policy is going away one way or the other. And so term life policies, they have a significant liability on day one with a very low premium associated with it. However, there's an end date to those. And there's several types of end dates. Either one is they term out. They just go past the term that they are designed for. The second is that they are lapsed. Lapsing a policy or replacing a policy. That happens all the time. A lot of people don't realize that only 1% of term life insurance policies ever pay a death benefit out. And it's because you have these other factors going in. People are outliving that policy and it goes away. People are replacing that policy. They are lapsing it for whatever reason. They determine they don't need it anymore. Those policies have very few claims that are actually death claims on them. And so it's important to recognize it's a little bit different than that. So, you want to try to compare apples to apples, and that's just not an apples to apples comparison simply because of that. One of the reasons why term policies are as inexpensive as they are is because they have such a high lapse ratio. When the long-term care policies first came out, they associated them very similar to a term life insurance policy. And they had a expected lapse ratio. Well, what we've seen in this industry is once somebody gets this kind of policy, they realize the value they've got in the policy, they don't get rid of it. Very rarely will we ever tell somebody to get rid of a policy that they've had for 10, 15, 20, 25 years. We might add to it. We might do something to augment that policy, but we rarely will ever tell somebody to get rid of that policy. That policy usually has some benefits that you can't get anymore. It also has a cost associated with probably less because it was based off of an age that was much more favorable for that premium. So it's important to recognize that the lapse ratios did not hold up in the long-term care business like they originally thought they would. And that's one of the reasons why we had such a difficult time when those transition periods started with so many people that weren't just giving up their policies, they were keeping those things. One of the best days for a term life insurance company is the day that you call them and tell them, I've replaced that, I don't want that policy anymore. Because at that point in time, everything that they've accumulated in premiums from you goes into their pockets, and there is zero liability for them going forward. And so they don't mind you calling and telling them that you're done with their policy. They're not going to fight you for it. They're going to say, yeah, that's great. Go ahead. Because they know at some point in time you'll potentially come back to them if they've got favorable rates and you need another term policy that you'll buy it from them. And so that's just one of the things about the insurance business. A lot of people don't realize how that works, and that's how that works. With so many carriers stopping to write these policies, we have to recognize that until we see a lot more competition and innovation come in, which I said we've started to see some, we're going to be in a situation where these prices are just going to stay like they are. And the issue is that we are not getting any younger. Therefore, we can't wait for the new innovations 5 years from now to come. We have to start looking at this today and base those decisions on what's going on today. Now, the good news is there are some new things coming in. We'll talk about those when we talk about specific products and stuff like that. But there are some more options that are becoming available. Now, they're not perfect for everybody, but they do serve certain communities and certain demographics well. But that all being said, it's important to look at this as early in life as possible. And that's the one thing I want to reiterate to you. The cost of waiting, your cost is in twofold. One, it is financial. You take somebody who's 45 versus somebody who's 55, those premiums are going to be dramatically different. And so the earlier you can deal with this, the better you can deal with it. The second is your health risk. And that's the thing, I've heard a lot of people say, well, financially, it's the smartest thing to do this at age 59. I've had one of my clients that said that. I said, okay, but you're making a huge assumption. You're making a huge assumption that you, who was 52 at the time, is going to be in the same health situation at age 59. And I don't know that we can make that assumption without potentially being wrong. And that's one of the issues that is out there. And, that cost of waiting a lot of times is just not worth it. The earlier you are, like I said, if you're 40 and you're looking at this, that's when you should start this planning. If you're 60 and you're looking at this, that's when you start this planning. It's not something that you need to wait another day for. Yeah, it would have been great if you could have done this 5, 10, 15 years ago. However, we can't go back and relive time. And because of that, we have to make lemonade out of lemons, because that's what we get into. Sometimes we get lemons, but what do? Try to make lemonade. And, we'd like to think that we can give you some guidance on how to do that. So, if you need to visit with somebody about your long-term care, you're planning, if you've never touched this or if you've done it before, if you have a policy you want to review, if that's sufficient for you, let us know. You can call us, 318-629-3777, or get with us at 318insurance.com, and let's start a conversation about that, because, there is no better time to plan for anything than today. And it's important that you recognize that you don't know what's going to happen tomorrow. I don't know what's going to happen tomorrow. I've got a pretty good chance that I'm going to wake up tomorrow morning and I'm going to be able to come into work and do the things that I need to do, but that's not a guarantee. And so because of that, we need to recognize that we need to do everything we can to plan accordingly. And that's the important thing of this. This needs to be part of a sound financial plan. And that's part of what we're trying to do out here. So let us help you walk through that. If you like and subscribe to our page, we'd appreciate it. We want to get this information out to everybody that we possibly can. You could be a conduit for that. Send it and share it to friends of yours that might be in this situation. It's an important thing that we're talking about here, but these are some of the conversations that people don't want to have a conversation about, and we understand that. However, we're not doing our job right if we're not looking at all the risks that are out there. I had somebody just the other day that called me about wanting a disability insurance policy. And I told them, you don't need to be worried about the disability. You're about to go onto Social Security, your disability right there. You need to worry about your long-term care. They didn't want to hear it at the time. Hopefully that'll soften over time and they'll realize, hey, that guy that I talked to really was looking out for me, because he told me I didn't need something that I wanted. He wouldn't sell me that. I realized that wasn't something he needed, that I need. However, he did tell me I needed to look at this other stuff. So this is a long-term conversation. We're ready to have it with you. Anything we can do to help you out, we'd appreciate it. Again, like and subscribe to our page. Let us know what we can do for you. If you got any questions, shoot us an email, and we'd be more than happy to ask them. That's all I have for today. Hope you all have a great day and the rest of your week. God bless.